This is going to be the most important video you ever watch on LEAP call options and how to trade them successfully. In fact, I've made hundreds of thousands of dollars utilizing this exact strategy, and I've grown my portfolio to 7 figures, and a lot of that was due to LEAP options. So buckle up, please take out some notes, a pen, pencil, and let's take some notes. I'm going to give you a full masterclass. Keep in mind, this is not financial advice, this is just for educational purposes, and I will have a detailed Q&A from the comments at the end of this video. Now, before we get started, Options Retirement Academy is a group of coaches. It's a new program, and I will link it in the comment section below, and I'll also include the URL here on the screen. So what are LEAP options? Well, let me just show you what a LEAP option is and go through examples and tell you the benefits of a LEAP option and why you would want to use this strategy. I'm going to be using Palantir as my example. Feel free to use any stock that you wish. Now, I'm going to pick an expiration date somewhere in the future. Would this be correct? Nope, it wouldn't be correct. Now why? Okay, well, a LEAP option is a long-term call option, okay? So you want to go out really far in terms of date. It's 365 days or more by definition. Now, a LEAP option is a long-term equity anticipated security over 365 days. The purpose is to give more time to a call option so you can make money if the stock goes up. Short-term call options are a lot cheaper, but they're a lot riskier. A LEAP option is a long-term call option, and a lot can happen. So if you're wrong in the short term, it's completely fine. The stock can recover, or you can even make money in the short term with LEAP options as well. We'll get into all of that. But the whole benefit is that you get to put up a little bit of capital and control 100 shares of a stock, okay? Rather than having to buy 100 shares of Palantir way out into the future, you can just buy a call option. So let me go for an expiration date. Let's actually go for an even farther expiration date just because Robinhood's not loading up all the premiums. All right, so let's go for December 18, 2026. Now, let's say that we want to buy a call option here, the 170 call. Now, I'm looking at 170 because for me, I like to have a 70 delta. Okay, here the delta is 0.6966. It's like I've been doing this for so long, I already knew it was going to be 0.7 delta. That's how close I was here. But anyways, 170 is a good strike price for Palantir for December 18 because the delta is 0.7. And the whole goal of a LEAP option is it's a call option that gives you benefit if the stock goes up. We're buying the 170, which means that we're already in the money meaning that the current stock price, which is 185, is in the money on the call option. It's above the call option. So there's two things that you should keep in mind. First of all, we're $15 in the money. Okay, so 15 bucks in the money, and the options value is $55.95. Right off the bat, the total cost here is pretty good. I mean, if you were to buy 100 shares of Palantir, you would have to buy it at 100 shares times 184. That's $18,000. Here we're getting basically the same benefit, but it's only going to be $55. There's a massive benefit here. So it's a fraction of the cost and it makes your capital very efficient. This gives you something called leverage. You have leverage and you get higher returns on capital. So the capital that you invest, you can grow it a lot more efficiently, I should say, with a call option, because it's less upfront and you get 100 shares worth of benefit. So for example, if Palantir were to go up to $250 per share, then basically you would have a gain here of $2,400 or about $2,500, which isn't that much you might think, but it's actually a lot compared to the total cost that you put up. So if Palantir were to go up to $250, you would make 50% here. This is just one example, and I'm going to show you more examples, but this is the first example that I want to go over. Now, the benefit of a LEAP option is that time decay isn't that effective on a LEAP option. Time decay is actually very small. You can see time decay here through the Greek called theta. Theta is basically tracking time decay, and every single day this option is losing about $5 worth of value, which is a very small amount compared to $5,595 of premium. So in one day, if basically the stock doesn't really go anywhere, well, then it would lose $5 worth of value. But if Palantir even went up by, let's say, $1, well, then this option would go up by 70 cents. And I'm getting 70 cents because you would multiply the delta times the $1, and that's how much the option moves. Delta actually keeps into account how much the option would move in value. Now, the cons of a LEAP option is that you pay for the time. So the option premium is pretty big compared to a short-term option. Like if I were to go to an option that would expire, let's say in January 2026, well, this is going to be a lot cheaper. Right here you can see that a 170 call is going to be about half the price, but it's also a lot less time. versus, almost 400 days. Now we only have 80 days. But the issue is that not much can happen in a short amount of time. Now, 82 days is pretty good amount of time actually, so this would be a medium-term option, but it wouldn't exactly be called a leap option. The other con of a leap option is that time decay still does work against you, just a lot slower. And leap options are leveraged products. So one of the things that I see an issue, especially with new people that might have a little bit less capital and they don't actually seek coaching, they do it themselves and they start buying a bunch of leap options, they start making a lot of money because it can be very lucrative in a bull market. They end up over leveraging and not actually having proper risk management when it comes to leap options. We'll talk about that in just a little bit. Let's go over another example of a leap option. I'm simply going to go to Apple stock. I'm going to show you a very safe leap option that you can utilize on Apple stock in case it were to go up. Now, I do have 1,000 shares of Apple and it makes up currently 5% of my portfolio. I don't have any leap options on it right now. I have a covered call and I'll make another video on a covered call very soon as part of this YouTube channel where I'm trying to share as much free knowledge as possible. All right, so let's go to the options here and let's go for a leap option on Apple. So let's go for a leap option that's going to go out to September 2026. Now look, if you were to buy 100 shares of Apple, it would cost you about $26,000. But now, if you bought a leap option, it would cost you only $3,000. The reason why it's actually a lot cheaper for Apple, and the biggest reason, is the implied volatility is a lot lower. So a lot less can happen to Apple versus Palantir. Palantir has a lot more volatility. And that's basically a double-edged sword. When a stock has more volatility, the options are going to be very expensive. That's because you can make a lot of money even in the short term. You don't have to hold a leap option until expiration. In fact, you can hold a leap option for however long you want, or when you have reached the profit that you want to make. And we'll talk about that as well. One of my key exit points is when I have made 50% on the options value. For example, if I bought Apple 260 call, and then in the next, say, 2 months, this option goes to $48, which is about 50% increase. Well, I would just take profit. I'd be happy with an increase of 50% in just 2 months. Obviously, that's a really big return. The break even here on this option would actually be $292 per share, roughly. And that's a really high amount compared to the current price of Apple. And here's the thing, that is a high amount, but that's at expiration. Of course, we have a lot of time, so Apple can go well above the 292 mark. So if you're bullish on a stock, you'd really want to buy leap options and utilize this strategy to grow your wealth and grow your portfolio. But the thing is, you also can make money in the sense that if Apple were to go up by 10 bucks, then the break even here doesn't really matter because you can just sell this leap option for a profit. So if Apple were to go up by 10 bucks in the short term, then this leap option would gain value. Now, Robinhood does have a simulation option, and I think that's available for your current position. So let's see if I currently have a leap option. I'm not really utilizing this strategy as much because in the Retirement Academy, and what I usually teach students is how to generate income. And leap options don't necessarily generate income. They're more so a tool for speculation and betting on a stock going up a lot. So I don't currently have any leap options, so I won't be able to show you a simulation, but I will in the future because something that I'm doing is I put $100,000 into an account and I plan to grow this from $100,000 to 7 figures in the near future. So if you want to see how I grow this 100K account to 7 figures and be part of the process, you already know you should be subscribed. Now, let's talk about technical indicators and what you should be doing for leap options because that's a huge part of it. So for technical analysis, I'm just going to simply go to Yahoo Finance. You can use TradingView or really any other tool that will help you analyze a stock. So what I'm going to do is I'm going to analyze Robinhood, which is ticker symbol HOOD. So I'm going to look at Robinhood right now, and I'm going to go over the technical analysis. So what I would do for Robinhood is, first of all, I'm going to go to the chart. And in the chart, what I'm basically going to look for is what is the momentum. The first sign that I get from momentum is just visually, where is the moving average? Is the moving average heading up? And in Robinhood's case, that's an absolute yes. This stock has absolutely rocketed from $30 per share roughly to almost $150 per share. So it has experienced a massive rise for a multitude of reasons. Of course, they're expanding, and I can cover this stock in more detail in another video. But look, right here, we're currently sitting at the middle of the Bollinger Band. The Bollinger Band is really interesting and it's based off of statistics. The Bollinger Band is something that I look at in terms of getting a sense if a stock is expensive or if it is cheap. Right now, Robinhood is in the middle of the Bollinger Band, and because it's in the middle, it isn't really expensive or cheap, it's about where it should be. But on a long-term basis, since the stock is up a lot, it would be really smart to have a leap option, especially if you like the fundamentals of the business and where the management wants to take the business in the future. I personally think this stock is going to have really strong cash flow. So let's go for buying a LEAP option. And let's say that on the technical chart, if we zoom out here, basically, if you draw a straight line, this stock is going to head towards 180 per share and much higher. Now, of course, that's just a technical chart, and there's a lot more to understanding where a stock will head than just a technical chart. So let's go to Hood right now, and let's just look at some of the options. Let's analyze the option chain a bit further. So here is Robinhood. I'm going to go to Hood options, and I'm just going to look at buying a call option for the far future. So the far future, again, is going to be about 365 days or more. So if I buy a call option right now, let's say 130, you can see that the premium here is pretty high. And again, the delta is right around 0.7. Funny enough, again, it's about 0.69. The implied volatility here is a lot higher than Apple, and that's why this option is a lot more expensive. So if I click right here at $45, it's basically $4,500. Now here's some really clear and easy exit rules. When you have made 50% of the option premium, then you're good, you can take profit. Another quick tip is if you basically made 10 to 20% in less than 7 days, well, that's also a good time to take profit. If you're looking to swing trade, you can do 20 to 40% within 4 weeks. That's also a good time to take profit. For me, I typically just hold for 3 months, and I keep it as a really easy strategy because I'm all about passive consistent income, and I don't really want to manage a strategy too heavily. However, if you enjoy managing a strategy more and you just really want to see, for fun, can you take profit real quick and see if you can reinvest those profits in other ideas, I think that's perfectly okay. Just make sure to keep your position size small, especially when it comes to LEAP options. For me, it should be less than 10% of your portfolio. When you've made profit of 10 to 50%, that's a good time to take profit. I usually close within 90 days before expiration, especially because I don't really want to deal with time decay. I don't want the option to start losing a lot of its value. Also, you don't really have to treat LEAPS as a long-term strategy. Again, you can trade it from week to week, especially if a stock is volatile and has some big moves in a weekly basis, then it can be a really fun strategy to make money with. For me, that's not as important. I'm just looking for longer term income, and I'm looking to generate income in retirement. All right, so for Q&A, there's 2 questions. The first question was from the comments that you guys submitted is what are the best stocks to do LEAP options on? And I have to say that it really depends. You want to be in a stock that you see a really good future in, that you can see yourself holding for at least 3 months to 1 year. Because the whole point of a LEAP option is a long-term strategy. The second question I got was, can you generate income on a LEAP option? And the answer is yes. You can actually sell call options on a LEAP option and generate income. That's called a poor man's covered call. And that's a strategy that I also plan to talk about very soon. It's basically selling call options on a LEAP option, and that's a good way to generate income. However, if you're really bullish, then that is going to limit your gains because a poor man's covered call is a position where basically you give up some of the upside in the position. So it's less of a mega bullish strategy and it's more of a neutral income generating strategy, which I actually like. So more on that coming soon. For now, if you want to check out the best strategy of all, it's the wheel strategy, and you should check out my video right here on the screen, which is the SoFi wheel strategy.